Well, good afternoon, everyone from beautiful downtown St. Louis, Missouri. Started as a beautiful blue, gorgeous day in downtown, recently turned into a bit of a rainstorm. So, welcome from rainy St. Louis, Missouri. And for those of you that I have not had the pleasure of meeting before, either in person or virtually, my name is Dave Finklang. And on behalf of our firm's partners, myself included, and all of our amazing colleagues and teammates from the mothership here in St. Louis, Missouri, and across the country, it's our pleasure and my honor to welcome you to our webinar, the first of likely many webinars on decoding the one big beautiful bill. Today, we're going to talk about what you need to know, not just for 2025, but also looking forward 2026 and beyond. So with me today, would love to introduce my colleagues joining me. And sorry, one slide ahead, Minna, please. So joining me today, my esteemed colleagues, Mr. Dave Danic and Rebekah Tucker, two of our firm's foremost experts in the one big beautiful bill. And behind the scenes, we have just quite frankly an amazing team of tax and accounting experts that have joined together to form our firm's one big beautiful bill team. So lots of experts in the firm that at this point, I've lost count of how many hours folks have invested in digesting the bill and understanding it for everybody. So for today, a few key things that we're going to hit on. The first of which is the basics of the bill itself. So for those of you, obviously, that were likely watching the election coverage last year, one of President Trump's key priorities was the bill. Affectionately named the one big beautiful bill because of the way that Mr. Trump likes to describe things. It is stuck. So this is what we're calling it, and this is what all commentators are calling it. So the bill is officially enacted with a very ceremonial and momentous signing on July 4th on Independence Day. Negotiations for the bill started much earlier in the year, so probably many of you saw it kind of ping pong around on the news, ping pong around on TV. So there have been various iterations of the bill kind of throughout the ping ponging in DC. And what we have enacted on July 4th is what our team has really been spending the time digesting, understanding, and learning. So a lot of what you'll hear today, there are way too many provisions in the bill to cover in a 1-hour webinar. I mean, dozens upon dozens of provisions that impact individual taxpayers, business taxpayers, a lot of provisions around the energy tax landscape, a lot of provisions around the foreign tax landscape. We're going to focus today, though, since there are so many provisions, on the items that we believe and our team believes are most impactful to the most amount of people. So the most amount of people likely joining us today, the most amount of people, in our client base as a firm, and generally the most amount of people in the country. That being said, if you're a client of the firm joining us, first, thank you for being a client of the firm. Secondly, if there are unique provisions that we're not discussing today, rest assured that your advisor at the firm is looking to the individual provisions that will impact you and your business. So we'll start today's discussion with individual tax provisions, which will then land naturally into the business tax provisions. We'll end the day very briefly on the estate tax. So things we're not going to go too deep into today. We just don't have the time to cover all of the foreign tax provisions. That'll be a separate and distinct discussion, but just rest assured there are a lot in there, and our international team have been focused on those foreign tax provisions. What we're not going to focus on a lot today, because it's a lot of what's coming out to make the bill affordable, if you will. There are many winners in the one big beautiful bill. A lot of commentators would tell you one of the largest populations that are the deemed quote unquote losers of the bill would be the renewable energy landscape. So there's a lot of provisions in the tax code that were incentives for renewable energy, both for individuals and businesses. A lot of those have either been limited, capped, or removed as part of the bill. So we're not going to spend, we'll spend a couple minutes on individual energy updates, but by and large, we're not going to spend a lot of time on the energy updates just because it's a lot of things that are coming out, but that'll be some follow-up material. And then At the end of the presentation, we have reserved some time for some questions and answers. But we would highly encourage you to use the chat function within the Teams webinar functionality. At the top of your screen, you should see a Q&A button. Feel free to hit us with Q&A throughout the presentation. We'll do our very best to keep up with those as we're going. And then, of course, for any we can't hit, we'll talk about those at the end of the webinar. And if there's just ones we inevitably can't get to, we'll find ways to follow up with you folks. So with that in mind, the key things, again, we'll talk about today, individual taxpayers. The bill will impact broadly many individual taxpayers, but you can see there's some that our team and we believe will be most impacted. And then the same for businesses. There's a lot of businesses that will benefit from the bill, a lot of business owners that will benefit from the bill, but certainly some key types of businesses and types of industries that we think will be the major benefactors from the bill. And with that said, you've heard me kick things off long enough here. I'm going to hand it over to my amazing colleague, Rebekah, to start talking through the individual tax provisions that we believe will be the most impactful. And again, these are not all the individual tax provisions, but the ones that we think kind of have the broadest base of applicability. So Rebekah, my pleasure to hand it off to you to start talking individual tax.
Thank you so much. And I want to repeat Dave's sentiment. Thank you everyone for being here for today's video. We are very excited. We've put together, I think, a really good presentation. So getting into our individual tax provisions, you can see here on the slide, there are several items that we're going to discuss today. Like we said, there is more than this. These are just the items that we find to be the most broadly applicable that we're going to address today. So let's get right into our first item, individual tax rates, tax brackets. So these items are not necessarily something that has changed. Under the TCJA, the Tax Cuts and Jobs Act, we were expecting an expiration of the current tax rates, which are the ones in the column on the right on the screen. They were expected to go back to the column on the left. So just comparing a few of those numbers there, the tax rates, the tax brackets were at a higher tax rate before TCJA, and we're set to go back to that. So the one big beautiful bill kept in place the current tax rates. Of course, there we could throw a whole bunch more numbers on the screen there to show you where the income levels fall, but just generally speaking, we are glad to see that tax rates are going to continue at what they have been. Another item here is the standard deduction. So we have had the benefit of higher standard deductions under the Tax Cuts and Jobs Act for the last several years, and those were also made permanent through the One Big Beautiful Bill. So the deductions that are on the far right column are remaining in place going forward. Now to start our discussion on some of the things that have changed. So SALT deduction, you may have heard the term SALT thrown around. So SALT stands for state and local taxes. SALT is a whole lot easier to say than state and local taxes every single time, but the SALT deduction is one that is included under itemized deductions. So for those individual filers who itemize your deductions, the SALT category is one area where you may be benefiting from some deduction. The SALT taxes generally include income taxes paid to a state, real estate taxes, personal property taxes. There may be some room for sales tax in there too. So it's a broad category. With the Tax Cuts and Jobs Act for the last several years, the maximum deduction that we could take on our itemized deductions for SALT was $10,000. So before that, it was a relatively unlimited number. Having it brought down to $10,000 at a maximum was highly discussed throughout the tax world, at least. The One Big Beautiful Bill for several taxpayers has now increased that cap. So for the next several years, you can see on the slide, it's 2025 through 2029, we will possibly have the opportunity to take a deduction up to $40,000 on state and local taxes if our income falls within the limits. So this income limitation, there's a phase out and it starts at $500,000. Once your income is above this $500,000, we'll walk through a phase out. The minimum that we can still deduct if we are itemizing deductions for the SALT is still $10,000. So we haven't lost any room in that sense. There's just the potential to take a larger deduction for several taxpayers. Another key item, so when the Tax Cuts and Jobs Act brought this limitation in that we had not seen before, a lot of states took the opportunity to enact pass-through entity tax. This is often short form called PTET, PTET, something along those lines. So the pass-through entity tax is exactly what it sounds like, and it is a state level tax that a pass-through entity can pay the tax and receive the benefit and provide the taxpayer, the shareholder or partner, a credit for that particular state. We're not going to walk through the calculation of that today, but it is generally advantageous for folks who have an investment of some sort, are a partner or shareholder in a flow-through entity, to take advantage of the PTE opportunity. With the increased SALT cap limitation, we still have the opportunity to participate in PTE. There may be particular circumstances, so please talk to your advisor if you have questions or you're concerned about what this looks like for you personally. But generally, it's still going to be a benefit to individuals to continue to elect into PTE taxes when offered as an opportunity. So we like to see that that is continuing. Now, I'd like to walk through just a few quick examples of what this increased SALT limitation will look like. So in our first example here, our taxpayers, who we are going to call our friends Tom and Susie. Tom and Susie are married for, I believe, all of our examples today. So in Tom and Susie's case, they paid $40,000 in those various buckets of SALT throughout the year. Their income level for the entire year is at $450,000. Because that's under the $500,000 income phase down, we get to deduct the entire $40,000 of SALT on their itemized deductions, and the tax savings on that $40,000 deduction, assuming a 35% tax bracket, is a $14,000 tax savings. In our second example, we've got the same factor on how much has been paid in SALT for the year, but now our income is over the 500, the initial phase down calculation. We've done the math for you, but the SALT deduction is now brought down to $25,000. So at the 35% tax bracket, our savings on that $25,000 is $87.50. Which again is still more than the 10,000 cap. So if we go to our third example, we will see that income at a level of $600,000, which is the tip top of the phase out income range for the SALT deduction. So our maximum that we can deduct for SALT on our itemized deductions now is $10,000 at a 35% tax bracket. That's a savings of $3,500. So I think that this is going to be incredibly impactful for individuals who are falling under the $600,000 income tippy top, that range, and those who are in high tax states. So states such as New York, California, we see high income taxes, we see high real estate taxes. The ability to gain a greater tax deduction for the taxes that we're paying to a state is a win for taxpayers.
Well, and Rebekah, I think your last scenario, example 3 with folks at a very high income level, that is the scenario where the pass-through entity tax for business owners is extremely applicable. Generally for highly successful, closely held businesses, so closely held partnerships and S corporations, if you're generating significant profit in your business, generally the business owners or primary principals will have significant income levels. So oftentimes they're the ones that we're finding that their state and local taxes are capped at the 10,000. So for those folks that are in those higher income brackets and are business owners of, again, those partnerships and the S corporations, the pass-through entity tax is going to be immensely powerful still, even under one BBB with the increased SALT limit just because of the way the income phase outs apply. So I just want to jump in on that last example because that's the one that sticks out to me for, for the very successful businesses, that the pass-through entity tax is still going to be one of, if not your biggest personal income tax plays to be able to net those state and local tax deductions at the corporate level.
Totally agree. Thank you, Dave. Our next item here is another change to itemized deductions. And this one isn't a huge change. It's very much consistent with what we've been seeing the last several years. So before the TCJA, we were able to take a deduction of the mortgage interest that we paid when the principal for our home was $1 million or less. With the Tax Cuts and Jobs Act, that top level, that principal couldn't be greater than $750,000. If it was, then we had a portion of mortgage interest that was non-deductible. The One Big Beautiful Bill has continued that $750,000 number. So we will continue to see potentially some limited deduction on mortgage interest that has been paid. The One BBB did throw in that mortgage insurance premiums now can be treated as interest and included in our mortgage interest deduction. So no crazy changes there. Just wanted to let you know about that. Another item that we have to discuss on our itemized deductions. So this is going to impact those who, again, itemize their deductions, but there's also an impact to those who take the standard deduction. So let's talk first about those who are itemizing their deductions. We are now going to see a new floor. So this means that the first little portion of our charitable contributions, we'll discuss the amount in a second, is not deductible. So rather than taking 100% of our charitable contributions on Schedule A and receiving the deduction, there's going to be a little piece of it that's not deductible. That little piece is 0.5% of AGI, which is adjusted gross income, essentially taxable income, with some nuance to the calculation. So that is something that I don't believe have seen before as just a straightforward change to itemized deductions, that there's a piece of it that is not going to be deductible. That's something to keep in mind as we're tax planning. That will take effect in 2026. Now, the change for those who take the standard deduction, that there will be an opportunity to deduct up to $2,000 for those who married file joint, or $1,000 for single filers of cash donations. So this will be in addition to taking the standard deduction. We will be able to take a little bit more of a deduction when we've made cash contributions during the year. Just a real, yeah.
Oh, sorry, Rebecca. I was gonna jump in before you got into your example. So, the past few years, for a lot of folks, the standard deduction, as Rebecca showed earlier, has been quite high. So for a lot of taxpayers, or a number of taxpayers, there have been less itemizers. And since charitable donations have always been really for folks that itemize their tax deductions, aside from a carve out a few years ago, a lot of people have not been keeping, quite frankly, the best records of their giving, whether it's to their church, children's school, or other organizations. So I think this is going to be, for those that are still taking the standard deduction, this is going to be a documentation update for them starting in 2026 to make sure they're actually tracking the amount of money that they're being so generous with. So I just think about a lot of folks that we work with that just, quite frankly, have stopped tracking that because there's not a big tax write-off. So that's something just to make mental note of, that you're gonna have to start tracking your charity, even if you are a standard deduction.
Completely agree. Thank you for calling that out, Dave. Having record of our charitable contributions, even when we're taking the standard deduction, will be a benefit to us going forward. So let's walk through a real quick example of an individual who is itemizing deductions. I've said that too many times today. And how that will work out on their individual return. So in this example, Tom and Susie have AGI of $400,000. They donated $20,000 during the year. We need to put in that 0.5% floor, which is going to be 0.5% of the 400,000, which means that 2,000 of our donations is non-deductible. deductible donations become $18,000, and our tax savings on those charitable donations is $6,300, assuming a 35% tax bracket. Another change, and this change is to all itemized deductions for those fall into the 37% tax bracket. So we saw the tax rates a little bit earlier. 37% is the highest tax bracket. The change here is going to be for all itemized deductions. We'll walk through a calculation here in just a moment. The calculation is a little bit complicated, but the idea here is that itemized deductions will not benefit the 37% portion of an individual's income. That was a really loud thunder crack. I apologize if everyone else heard that. So the difference between the 37% and the tax bracket right before that, 35%, there's 2. So it's a 2 over 37ths calculation. This increased change to itemized deductions is going to start again in 2026. So if we go to our example, here in this example, Tom and Susie have AGI of $700,000. Itemized deductions for the year are $100,000, so that's made up of $10,000 in SALT because that's the cap that they fall into, and they paid more than that, so they can deduct $10,000. We're saying that they paid $10,000 in deductible mortgage interest and $80,000 in charitable contributions. We're first going to disallow 0.5% for the floor, so that takes away $3,500. Then we are going to do our 2/37ths calculation, and in this case, that's 2/37ths of itemized deductions. So we are disallowing another $5,216 on that. So our total itemized deductions after these 2 new limitations is going to be $91,284. At the 37% tax bracket, our tax savings overall on our itemized deductions in this example are $33,775. So there's a little bit of a lost benefit there just due to the new limitations. So there's a few significant planning points that come out of this. If you are an individual who is in the 37% tax bracket, or you expect to be in the next several years, there are a couple items that we want to address to plan for this. So because all of these limitations, the 2/37ths, the 0.5% floor start in 2026, it may be time in 2025 to consider higher charitable contributions where we can take advantage of the full deduction of our charity. So that's one thing to talk to your advisor about. There is also we're going to consider, maybe a way to make those deductions in a current year. Maybe we know that in a few years from now, we want to give to XYZ charity, but we're not prepared to give it to them just yet. There are opportunities to plan, including a donor advised fund or a private foundation, where when an individual contributes to these funds, we get the deduction in the year that we contribute to the funds, and then the fund pays the charity at a later date. So I think there's a lot of opportunity to discuss, to plan, to think ahead over the next several years, and to take action before the end of 2025 to make sure that we're prepared to go into the next couple years for our charity planning. Another deduction change here, and so this is for all individual filers, regardless of itemizing or taking the standard deduction. We might have the opportunity to deduct vehicle loan interest. So this deduction is available for years 2025 through 2028. The maximum deduction that can be taken is $10,000. And the phase out, there's an income level phase out for this as well, begins at $200,000 for married filing joint or $100,000 for single filers. And again, this is not directly related to itemizing deductions. There are a few criteria items that must be met for us to be eligible to take the vehicle loan interest deduction. Indebtedness for the vehicle must occur after 12/31/24. The final assembly of the vehicle must have been in the United States. and you must be the first user of that vehicle. So these are all things to consider in taking the deduction for vehicle loan interest. If we take a look here real quick at our example, we're going to say that Tom and Susie in this example have AGI of 150,000. They paid at least $10,000 in vehicle loan interest at a 22% tax rate, because that's approximately the tax rate that they would be in with this income level. We would see a tax savings of $2,200. This is an area where I wouldn't tell you to go purchase a new vehicle and take on a new vehicle loan for the sake of the deduction, but it's something that if you were planning to purchase a vehicle already, this is an opportunity to consider where we might be able to take advantage of a tax deduction. Next, let's get into some senior and family provisions. So we've got a big dollar amount here. We are looking at senior taxpayer benefits. There is an additional deduction of $6,000 per taxpayer. This is for seniors who are age 65 and up. The benefit, this additional deduction, is available for years 2025 through 2028. And there is an income phase out for 150,000 married filing joint, 75,000 single. But I think that this additional deduction is significant and incredibly impactful for our seniors. Seniors who are taking, let's say, the standard deduction, maybe they're also getting an additional deduction for charity outside of itemizing. Like we said, we can take up to 1,000 or 2,000 for cash contributions for our standard deduction folks. And then we've got an additional deduction here of $6,000. So I think that there is opportunities to discuss kind of on both sides of what we have for this additional deduction on looking at Roth conversions. Maybe something that we would have considered in a current year for a Roth conversion, maybe it doesn't necessarily make sense to take on additional taxable income in the current year because we're going to have a deduction in the future. Or maybe in future years, in the next several years before this provision expires, we will have lower income in general, and maybe it'll be a good opportunity to do a Roth conversion when we have an additional deduction to kind of absorb some of that additional taxable income. So I think if for folks who are near retirement or possibly in retirement and looking at some planning opportunities, this one could be very significant. Another senior and family provision that we have to discuss today is Trump accounts. So these are a new concept. The idea of a Trump account is essentially an IRA. The IRA will be set up for children who are born between 2025 and 2028. And during this time, this pilot program, the Treasury will deposit $1,000 into the appropriate accounts. This initial deposit and then any future contributions that we'll talk about in a minute will grow tax deferred. They will be in this account until these children grow to the age of 18. There is the opportunity to contribute another $5,000 annually to these Trump accounts. And one key item to take away from the Trump account provisions is that employers can contribute up to $2,500 of the $5,000 per year and exclude from employees' pay. So we have the opportunity here to receive a benefit when it's set up with an employer that $2,500 of the $5,000 maximum contribution in a year going into these Trump accounts is not taxable income. So again, these are tax provisions that are meant to encourage, of course, the growth of our future. We also have the child tax credit. So a lot of what we've been talking about previously has been a deduction, and a deduction. So we start with income and then we take a deduction and then our tax related after that. A credit, on the other hand, comes into play after the tax is calculated. A credit generally offsets tax oftentimes dollar for dollar, not necessarily, but it is a direct reduction of the tax that is calculated. So we have seen the child tax credit for quite some time now. The pre-TCJA amount of child tax credit is $1,000. What it's been during TCJA the last several years has been $2,000 per child. We were set to revert back to the $1,000. So the one big beautiful bill expanded the credit, and the 2025 credit is going to be $2,200 per child, and index for inflation going forward. Previously, the 1,000 and the 2,000 have not been indexed for inflation. So we're going to see that that number changes a little bit every year. This provision has been made permanent, and it does have an income phase out. So that income phase out is for 400,000 married or 200,000 single. There is also the opportunity for potential refund of some of the credit for those in lower income brackets. As a very quick example, Tom and Susie, who have AGI of 150,000, have 2 children. Their maximum child tax credit is looking like $4,400. We've got a couple more credits to discuss. So the credits mentioned here on the screen have been in play and were set to expire at some point, but the OBBB sped up the timeline that we have to address these credits. So you can see here that at the end of September, we see the clean vehicle credit and commercial clean vehicle credits expire. Please note that in order to take advantage of these credits, you must take delivery of the vehicle by September 30th. Even if all the paperwork is in and we have the intention of having the vehicle, if we don't have possession of it by the end of September, we are not going to be able to take that credit. Similarly, at the end of the year, December 31st, we're going to see the expiration of the residential clean energy credit and the energy efficient home improvement credit. And these also need to be fully paid and fully installed by the end of the year. Again, if there's a little bit of overlap, if we're only 80% done at the end of the year, we are not eligible to take the credit and the credit will expire. So don't want to cause panic unnecessarily here. But if these are items that you have been considering looking into or were planning to take advantage of in the year of 2025, we need to be taking action today to make sure that we're there and we're able to take advantage of these credits. Just a couple more items from me before I hand it over to Dave. And our couple items that remain are going to bridge the gap between individual provisions and business provisions. So let's chat about these. These are entirely new to the bill. We have not, to my knowledge, seen these before. So our first item is tips. So there's a potential to take a deductions for those who work in the service industries up to $25,000. This is only for a handful of years through 2028, and there are AGI limitations that apply. You can see those on your screen. Please note that, and again, this is why this bridges the gap between individual and business provisions. The record keeping requirements are on the employer to provide this information to the taxpayers so that when they go to file their 2025 through 2028 tax returns, they know how much they received in tips so that they can consider that deduction on their personal returns. So let's walk through a couple examples here. In our first example, Tom and Susie have $250,000 of AGI. They are under the $300,000 beginning of the threshold, the phase down. So they are able to benefit from a $25,000 deduction of the tips that they received during the year. In our second example, their income spiked tremendously and they had $500,000 of AGI. Walking through the phase down calculation, they will be able to deduct up to $5,000 of tips. Last but not least, we have overtime. And the overtime, a lot of the factors are very, very similar. So again, this is on the employers to keep record of overtime paid to employees and provide that information to employees so they can file their taxes appropriately. So the deduction in this case is 12,500 or 25,000 for those filing married. Let's walk through our examples real quick. These numbers work out to basically the same because a lot of the items here are the same. So Tom and Susie in example 1 are under the income limitation, so they can they're eligible to deduct up to $25,000 of overtime. In example 2, they've started into the phase down, so their maximum deduction is going to be $5,000 of overtime pay. So with that, I'm going to hand it over to Dave, either Dave 1 or Dave 2, and we'll take it from there.
Great, thanks, Rebekah. It'll be Dave 2 today who takes the handoff. But regardless, great content on the individual side of the OB3. I call it OB3. There's really no standard acronym yet, at least not that I've heard. But you'll see on our screen, there's only 6 bullet points. Why? Well, because on the business side of things, while there's a lot of noise about OB3, a lot of the business provisions are really extensions of some of the major changes that took place in 2017 with the Tax Cuts and Jobs Act. So you're going to hear the word permanent a lot. And that's going to be our word of the day. Why? Because things that are and provisions that our business owners have been used to have been made permanent, which really allows a lot of certainty for them to operate their businesses and make investments going forward. So we're going to start with the QBI deduction. Everyone has heard this term at this point if they are a flow-through business owner, a partnership or an S corporation, QBI. And the quick example is if I was a flow-through, I made $1 million through that, I was only paying tax on 800,000 of it because of this 20% deduction. And there's the word, it's been made permanent. This was ping-ponged between the House and Senate versions. Were they going to increase it to 23%, lower it to 18%? Well, like many things in Congress, nothing happened. They left it at 20%. So a lot of certainty for our business owner clients moving forward on this one. There were some minor changes, and this is that middle column, is that there's an expanded threshold for service businesses. If you're an accountant, an attorney, a performer, or an artist, you were phased out of taking the deduction if your income reached certain limits. Well, so now that phase out has increased to about $545,000, and the length of time that it takes to phase out of it has increased. So that $150,000 for a married filing joint couple, you might see a slight increase in your QBI deduction from year 1 to year 2 under OB3. And then there's also a new minimum. So if you have QBI of $1,000 or more, there's a minimum $400 deduction. That's 40%, and it's capped at that number. I don't know why they put this little provision in here. My guess is that it's just to inspire some new economic activity, new businesses on the lower economic spectrum. All right. Our next provision that I think is going to be more impactful for our clients are the enhanced depreciation provisions. And you'll see that I have 2 big bullet points on this slide. It's bonus depreciation in Section 179. We know and love these terms, right? So you have a client or one of our clients comes in and says, hey, I bought a truck. Can I 179 it? Or, hey, I bought some equipment. Let's bonus it. Well, it was not as easy as it seemed in the background of saying what type of depreciation we want to use on this one, because there are some differences. Well, I think we're going to have a more certainty going forward. For the bonus depreciation side of things, it is 100% immediate deduction, and that is a permanent provision. So over the past 5 years, we've been looking at the stair step down on the amount of bonus depreciation you can take, and it was supposed to go away at the end of 2026. Now we don't have that uncertainty. And it's important to note for 2025, it's for equipment that is acquired and placed in service after January 19th of 2025. Both those terms are important. You have to have it acquired and actually get it in motion, place it in service. Also under the bonus depreciation, you'll see 3 new words here: qualified production property. This is a new term that we haven't used before. And so this is a factory, a manufacturing facility with the goal of the bill saying we want to bring production back into the United States. So if a business client constructs a new factory from January 19th and completes construction before the end of 2029 and actually gets the factory up and running before 2031, there is a huge opportunity to get more bonus depreciation on this factory rather than a more extended depreciation timeline for other real estate projects that might be like 39 years. So we see some great opportunity for businesses that are looking to expand rapidly. Further, there's a provision that if a business acquires a factory that has been idle for over 5 years, I think the date is around 2021 or 2020, then even getting a factory back online is an opportunity for more bonus depreciation. So some nice incentives if you're looking at some major investments into your business. And then the bubble below it is the Section 179. It used to be 179 was limited to how much you could take, usually around the $1 million or the $1.5 million. It would adjust. Now it's at a $2.5 million maximum amount that you can take for that immediate year write-off. Okay, and again, this is for assets placed in service in 2025. So what are we working with our clients? Well, it all depends on what type of equipment you're buying. Some bonus depreciation can be used for certain things like land improvements, parking lots, and such. 179 might be able to be used for other larger systems such as security system, HVAC systems. So please call us if you have questions on which one's the best to use, especially as you're forecasting your taxable income out into the future. Our next slide shows a bonus depreciation. This puts it in more graphic terms for you. That middle column, you can see that stair step down to 0% of what bonus depreciation is. And then on the right-hand column, you've got the OB3 bonus depreciation with that switch in 2025. And then after 2026, we continue with 100%. Okay, our probably the most impactful part of this for our client base is the research and development changes. Long story short, in 2022, if you had a business that had some research and development costs, you were not able to fully get the write-off of the expenses that you incurred. You had to capitalize and amortize them over 5 years. And that's a lot of big words I use to try to sound smart, but all in all, it just meant I had to pay a bunch of tax on when I already spent the money on the expenses like wages and equipment, and now I have to pay tax on this and write it off over 5 years. It was a really negative provision. Well, Congress heard the letter, heard the commentary, read the letters. They fixed it, and now 100% expensing is back. So for 2025, all of those R&D costs, you are able to deduct them. And used in conjunction with a research and development tax credit, it's back to being a very positive tax provision for our business clients. But it's like an infomercial. But wait, there's more. So if I am a small business with gross receipts under $31 million on average, I can actually go back and amend my tax returns from 2022, 2023, and 2024 and actually recoup those expenses that I was unable to claim and hopefully get some nice needed cash flow back into my business. All right, so running through a quick example of what this would look like here. This example is saying on average, if if my client had $2 million of annual research and development costs, you can see in 2022, pre-OBB, I could only deduct $200,000 of these, meaning I was paying tax on $1.8 million of phantom income. So $378,000. Now, I'm not going to go through every line right now, but as you can see, it took me until 2027 to actually get made whole for all that money I had spent in tax dollars, and then going 2028 and 29 to finally get some tax benefit. So if I'm looking at this and I fall under that $31 million threshold, going back 22 through 24, I can see potential refunds of $882,000. And I would love that cash flow so I can keep investing into my business and keep the research going. So we see a great opportunity for our clients that felt this negative provision. And I think there's going to be a lot of great opportunity to get some cash flow back into the business. So what am I considering here? I think it's not as easy at just saying yes or no when I see those big dollars. We're asking questions. What type of entity are we in? Are we a flow through, like a partnership or an S corporation? If I'm an S corporation and I have to go amend 22 through 24 and I have 45 shareholders, that's a lot of administrative burden to get those K-1s out and have to amend all those tax returns. If I'm a partnership, this is beyond the scope of this webinar, but we're awaiting more guidance on what happens for a partnership that falls under some provisions called BBA and the allowance to amend a tax return. If I'm a corporation and I had loss years for 2022 through 2024, if I go back to amend those years, am I just creating a bigger NOL and a bigger pile of credits that I won't be able to use into the future? So I don't think it's as easy as saying, yes, let's go back into amend these things. You really want to work with your advisor to see what my profit is going to be into the future over the next several years.
Well, and Dave, one thing that I know you and I have talked about a lot related to the research and development change, just given the broad applicability to our client base and our individual clients, we can look at going back and amending and taking into account all these considerations. The ability to amend is for folks or for businesses with revenue of $30 million, $31 million or less. So those are deemed small businesses in the bill. So those folks have the ability to go back and amend, but we don't necessarily have to go back into amend to kind of recoup some of that chart that we hadn't amortized yet, because the bill will allow us to pick up that deduction and all in 25 or split between 25 and 26. So, maybe because of all these things you presented, it doesn't make sense to amend, but, perhaps we're going to do that, kind of catch up in 25 or 26. And then for businesses that are over $31 million in revenue, that, we're looking at 25 and 26 as our opportunity. So this is certainly one of, arguably, for many businesses, one of the biggest wins in the bill, because we've in theory been waiting for a fix on this for years. But as is everything in the tax world and everything out of DC, it's immensely more complicated than what first meets the eye. So, Dave, I just wanted to jump in here.
That's a great point.
Just appreciate
the
example you put together and all these considerations we have to think about, because it is going to be some conversations that have to be had. And I like the position we're in that it's the middle of the year, or roughly the middle of the year. So we have some time to plan before year end, and they gave us a 1 year time frame to be able to amend. So we've got some time to think about this and account for these things. But yeah, it's not as, originally I think it was going to be yes, no, let's amend. Now it's, we got to spend some time on this. But yeah, I just wanted to jump in on a couple other thoughts, since this is such an impactful thing to so many of our clients, but then just so many businesses around the country.
Great points. All great points. Thanks for jumping in there. So we're going to put a pin in the R&D and move on to our last three business provisions at this point. And not that they're less important, but we just see them impacting a smaller subset of our clients. The first one being QSBS. Boy, we love our acronyms. But this is the Qualified Small Business Stock Exclusion. This has been around since the 70s, I think, and it was put in place by Congress to inspire investment into new startups. The opportunity is great, but when there's always a cost. So there's a lot of angles you have to look at when we have someone that's investing in this startup. Long story short, though, there's 4 provisions you need to look at with QSBS. If I'm investing into the C corporation, if it has to have a value of less than 50 million, well, that 50 million is now 75 million. So again, we're making the pool bigger for people, for these startups. And also in the past, I had to hold the stock for 5 years to get this capital gains exclusion. Now, when I can dispose of this stock after 3 years and get a 50% exclusion. What's all this mean? Okay, if I'm a heavy hitter and I invest $1 million into a startup, I hold it for 5 years and I sell the stock for $10 million. That's $9 million of capital gains that can be, I don't pay tax on as an investor. So wow, that's a huge amount. Do some math on that. I mean, we're in the millions of dollars of tax savings. And if I spread that out amongst my cap table and I'm a startup, you can see that there's some immense savings here. But those are the numbers that we're talking about, some pretty big incentives here. And then on the right-hand side, you'll see that there's an exclusion amount. Now, instead of excluding 10 million of gain, I can exclude up to $15 million of gain. So it's a pretty, it's a very lucrative provision that's been around for a while. Kind of fell out of favor with the advent of S corporations and a lot of the immediate tax savings that business clients could see by operating as an S corporation. I think we're going to see more of this, especially in the startup landscape, moving forward. And then the last provision we did put on there, the qualifying trade or business. Again, us accountants, finance, engineering, lawyers are not able to partake in this benefit. Okay. Next, we're going to talk about excess business losses. This was put into play back in 2017 to help pay for the Tax Cuts and Jobs Act. I'm not going to spend too much time on it, but here it is. We made permanent again. This was for businesses that had some pretty large losses that flowed through to individual returns. The law says you cannot take all of those losses in year 1. So then it converted those losses to net operating losses that had its own subset of rules that you were able to take the losses in the future years. So again, it just spread those deductions out into the future to help pay for the Tax Cuts and Jobs Act. All right, and then our last business provision that we're going to talk about today is the business interest expense limitation. And talking with Ryan, and well, again, shout out to our technical team that helped put this content together. They were nothing short of amazing by getting through these 900 pages. He says, hey, it's about 5% of the clients he works with. So kind of across the board, it's not too many. But at the end of the day, this was put into play for businesses that had a lot of interest expenses. So a lot of heavy interest-heavy businesses that they were limited on how much interest they could deduct. Well, they changed the calculation to allow more interest to be deducted for these businesses by including depreciation and amortization to be included in the calculation. So now, if you can see how we're using these terms a lot. So now with more bonus depreciation being allowed, we can see more interest being allowed to be deducted for the businesses that are subject to the business interest expense limitation. But all in all, that's what we feel were the big points, big considerations on the business side of things, a part of OB3. And with that, Dave, I'm going to bring it back to you to close us out with some estate tax provisions.
Hey, all right. Well, thank you very much, Dave. And again, thanks to Rebekah for covering such an in-depth analysis in relatively short amount of time on the individual tax front. The last item we want to touch on briefly before kind of wrapping up in the next 5 minutes here. so impactful to many of our clients at the firm, but then also so impactful to so many families around the country, relates to the estate tax and estate/gift tax. So one of the somewhat talked about but lesser talked about provisions in the bill relates to the lifetime estate and gift tax exemption amount. So as part of OBBB, or Dave, I like you, the OB, did you say OB3? OB triple three? Can't remember what you said, but I liked it. So under the bill, the exemption for lifetime estate and gift tax is now $15 million per person. And for married couples, that then multiplies times 2, so $30 million for married couples. This, as part of the bill, is permanent, but like a lot of the things we've talked about today, they might be permanent, but they're only permanent so long as this bill is in place, or generally until the next president or next administration. The estate tax especially tends to be one part of the tax code that gets changed quite frequently on us with changes in administration. So what we do know, for the tenure of Mr. Trump's presidency, these things will be permanent, or highly likely to be permanent. With the next administration, it's hard to tell, but we have a few years here. The one thing at the bottom of the slide I do like to call out, these amounts are indexed annually for inflation, so they will go up year over year. And the last point, these do apply to the generation skipping transfer taxes as well. So both of those exemptions are now 15 million. And what I want to leave you with on the estate tax is kind of a comparative, because I think that is what's really impactful from this bill. So in the next slide, if you don't mind. So you can see in the far left of your screen, the OBBB exemption, just like we showed you on the prior screen, 15 million for single and $30 million for married couples. Currently, the next column over, it's just about 14 million and just about 28 million combined. So you're probably thinking, well, that's not that impactful of a change to go from 14 to 15. I mean, it is, but not in the grand scheme of things, a lot of people would say. Well, the current Tax Cuts and Jobs Act column isn't really the most important one here. The column to the right, the 2026 and after column, is the most important comparative here. Because absent the OBBB, the 14 million and the $28 million were set to expire, set to sunset at the end of 2025, such that in 2026 and beyond, it's expected that the exemption would be roughly 7 million or $14 million for married. And I say roughly because it's set to sunset to 5 million, but that 5 million was indexed for inflation. And most commentators think that with inflation, we'd be around the 7 million and the 14 million. So really, it's the comparative of the bill to 2026 and after that leaves us our increase in the exemption column. And I think that's what's most impactful on this slide. So at a 40% either gift or estate tax rate, depending on whether you're gifting things during your life or it's transferring your passing, for a single person, this could make up to a $3.2 million savings just by the change in the exemption, and 6.4 million for married folks. So very impactful change here. And the one thing I want to revisit is this is permanent, at least within this administration. So I think what this does is there's a lot of folks this year up to the passing of the bill and in 24 leading to 25, they're making some rushed or slightly less than strategic estate and gift tax planning moves. So this bill, at least for the tenure of the presidency, gives families and gives their estate planning teams, either at our firm or their respective firm or law firm, some time to plan a lot more strategically. So this is what I'm particularly happy for families with potential estate tax issues under the old law, is this gives us some time to plan. So with 3 minutes, 1 minute to go, let's wrap up really, really quickly here. A quick slide, and we're going to share these slides with you. So a lot of resources, but there's a lot of industries that will be impacted, a lot of individuals will be impacted, but these industries in particular, we think, just from diving into the bill, will be absolutely some of the most impacted. So we're looking at these industries very, very heavily. The next 3 slides, as I mentioned at the onset of the presentation, the bill is almost 900 pages long. I mean, there's dozens upon dozens and dozens of provisions. We can't hit them all, but what we wanted to give you were just a few example slides of the other provisions that are out there that we'll be looking at for our clients, and hopefully you'll be looking into for your businesses. So lastly, kind of action items from today. You know, what I think was really impactful about the bill, aside from everything we shared with you today, is the fact that it's August and we're talking about it. The bill is passed July 4th. Oftentimes, we don't see significant change in tax legislation until the end of the year, or sometimes it's January, retroactive to the year before. So we're in such a unique position as individual taxpayers and as business owners to be a bit more strategic about our financial moves and our tax moves. So certainly what to do now, we need to think about the 2025 provisions that need to be implemented by the end of the year. We have some time to plan, but we need to be thinking about 2025. And then longer term, let's think about those type of provisions that will be most impactful 2026 and beyond. Because as you can certainly see from the bill is very much so incentivizing businesses that want to bring manufacturing back to the United States. They want to bring R&D back to the United States. The bill wants to incentivize companies to implement R&D strategies. I mean, this bill is all about what Mr. Trump talked about in the campaign trail, which is a lot of, yes, business-focused incentives, but by and large, the hope is that those business-focused incentives will bring jobs back to the United States, high-paying jobs in the United States. And then there are plenty, as you've seen, plenty of individual tax provisions that will benefit, the average American family and even those that are higher earners. So there's a lot in the bill that I think benefits everybody, but certainly it does have a bent towards businesses, because the belief, at least in the bill, is businesses will bring jobs back to the United States. So I know we didn't leave much time for questions, but here on the very last slide, Min, if you don't mind jumping to the very, very end, you will have our contact information as a firm. And then for those of you that are Andrew's clients, again, thank you very much for your trust, whether it's been a 1-year relationship or a 60-year relationship. We value every single one of our clients. We thank you for your trust. Feel free, if you have not heard from your advisor yet, as we're digesting the bill, feel free to reach out to them. If you're not an Andrew's client yet, we'd love to have the opportunity to speak with you and help you through the bill. But hopefully in an hour and 2 minutes, we've been able to open your eyes to a lot of the benefits that we believe are in the bill for individuals and businesses. There's a lot of follow-up to be had. We have some time to plan, thank goodness. But again, thanks everybody for joining us today. I want to thank my colleagues, Dave and Rebekah, for joining me as presenters today. Thank you to our amazing One Big Beautiful Bill technical team that's helped for the past couple of months distill the bill, digest the bill, get the bill ready to roll out to our firm. And lastly, of course, to our amazing marketing team that takes all this technical content that we throw at them and make it a beautiful presentation now, and then make, as you see in the background, make our website so beautiful. So the last thing I'll leave you with, if nothing else, please head to our website. We've built out an entire sub-website for the One Big Beautiful Bill. As we're pushing out updates and resources, you'll see them on the website, and then we'll push them out to you. So thanks again, everybody. Have a great rest of your day, and hopefully the rain leaves St. Louis, and I can again say, welcome to a beautiful, sunny, blue day in downtown St. Louis. Have a great day, everybody.